Every day, all across America, people are going to work. From fast food restaurants to high-rise office buildings, every business has one thing in common: expenses. When you work in an office, everything around you, from the desk to the computer to the stapler, even the electricity has a cost. There's equipment that's necessary for running the business. That equipment costs money at the time of purchase, but it also costs money to maintain. There are also other types of expenses that can be tax deductible for businesses. For a company located in the business district of the city, the expenses that they incur for all of these things are pretty obviously tax deductions. But what about the people who have a business in their home? Meet Jill. Jill is a senior sales director with a well-known cosmetics company. She has an office in her home where she stores her inventory, schedules her appointments, places her orders on her computer, and even conducts training with new consultants. She also uses her dining room table for classes and facials, and this living room area for meetings with consultants.
What?
For meetings with consultants? That's better. There's a cost to running business here, just like there is for the businesses downtown. It costs money to purchase all of the office equipment, to pay for the utilities, and even to supply coffee for her clients. It turns out that even the IRS acknowledges that there is a cost to running a legitimate business from your home. If you go to their website and type in "office in the home" in the search bar, you'll find two basic requirements: regular and exclusive use, and principal place of your business. Let's take those requirements one by one and apply them to Jill's office to see what parts of her home will qualify. First, regular use. Does Jill regularly use these three spaces for her business? In all three areas, the main office, the dining room, and the living room, the answer is yes. Okay, next test. Exclusive use. The IRS says to qualify for this, you need to use a specific area of your home for only your trade or business. So let's take Jill's rooms and see if they qualify. First, her office. Here we have her desk, her computer, her inventory. It's pretty obvious the only thing going on in this space is work. What about the dining room? Normally, a dining room would be for, well, dining. But in Jill's case, it's serious business. No dining in here.
Come on.
Thanks, Will. Last but not least, the living room. Here we have a sofa, some chairs, a TV, and Will. Again.
No.
But the exclusive use test.
No.
Okay, fine. Even though Jill does have consultants meet here once or twice a week for training, and she does use the TV to show training videos, the rest of the time this room is used like any other living room, hanging out with family, watching movies, maybe even eating dinner. So this room doesn't qualify for the exclusive use test. There's one more room we want to consider, the powder room. Is this room going to meet the regular and exclusive use test? Regular use? Probably. Exclusive? Maybe not. But it is important to note that there are some expenses associated with the upkeep of this space that would be deductible. Toilet paper and cleaning supplies would be ordinary and necessary, so a reasonable amount of those items could be deducted with your regular business expenses. What if you have a room that has two very distinct spaces and purposes but isn't divided by a wall? 2/3 of it was used for family hangout, but the other third had her desk and her computer and other business items. According to the IRS, the space does not need to be marked off by a permanent partition, meaning walls. So in that case, the portion that Jill used for business could be her home office. Okay, so now that we figured out that Jill has a couple of spaces that can be considered part of her home office, what do we do with that? First, we are going to need to take some measurements. Number 1, square footage of your office space. Number 2, square footage of your heated living space.
Hey man, I just gotta take some measurements. It's for my job!
If you or your CPA are using software to calculate your home office expense, you'll plug both of those numbers in to come up with a percentage. For our example, let's say Jill's office is 15 by 20, or 300 square feet, and her overall heated living space is 2,000 square feet. The percentage for her home office is 300 divided by 2,000, or 15%. Okay, so we have a percentage, so what? Now it's time to think about all the things that you pay for every day to keep all of your home running. Mortgage or rent, utilities, internet service, home or renter's insurance, property tax, repairs and maintenance, property improvements, janitorial or cleaning service, lawn care, pest control. You'll need to get a total for each of these items for the entire year. For repairs and maintenance, you would want to include only those repairs that affected the total house. Repairs to your HVAC system, resurfacing your driveway, or planting flowers in your front yard. These items would be expenses that would affect your ability to work in your home or would be something your client would see when they came to see you in your office. Repairs and maintenance would not include remodeling your master bathroom. All of those expenses will go on Form 8829.
Expenses for business use of your home.
If your office area is 15% of your home, then you will be able to deduct 15% of those expenses. This sounds like a great deal, so why wouldn't people want to do this? Two basic reasons. First, they don't understand that running a business from their home does actually cost them something. Why should the businesses on Main Street get to write off the cost of their utilities and rent, but not Jill, who's paying for her office space and utilities in her home? Second, and this is the big one, they're afraid of taking the deduction is going to increase their audit risk. This fear is sort of like paying the mafia a protection fee so that they'll leave their business alone. It's voluntarily paying more tax than you think you should just to keep the IRS at bay. To address this issue, I'd like to talk to two groups of people. The first group, the people who keep good records. Hi there! Since you keep great records, you'll be able to support any legitimate tax deduction. Great job! Now I'd like to talk to those of you whose records are less than perfect. You have legitimate expenses and you do deserve the tax deduction, but if you haven't kept good records and you're audited, the IRS might not allow those deductions. So let's fix that problem rather than you pay more tax than you should. Call me to schedule an appointment to discuss ideas on record keeping. You can also check out my record keeping video coming out December 2015. That's it for now.